Marc Johnson. He works for Pinion Global out of Kansas City. Let's come on up, Mark. Take a look.
Sorry, I snuck in a little late this morning. That's really intimidating. We got to sneak into the front of the room instead of the back of the room. I had to stop the lady outside and say, okay, which one of these doors should I come in and not interrupt too much? But I was late because I found out this morning that evidently you can get pulled over by a Cessna airplane in Iowa. That's news to me. So, in case any of you think you are smarter than the police, you're not. Because my Google even popped up. My Google Maps popped up and said, "Is there still a policeman ahead?" And so I looked forward and I saw like 5 cop cars. And I was like, "Oh, that's nice. I love Google." So I slowed down, and then he pulls me over anyway. I'm like, oh, we were way in the air. We got you 3 miles back. So I was like, oh, dang it. So, oh well. So that's my story for today. I don't know how many of you ever had to give a presentation where you thought you were going to get lucky because then somebody calls and says, hey, can you give this presentation? You're like, oh, yes, I already drafted it. My PowerPoint's done. All I got to do is come and show up again and give the same PowerPoint again. Well, that's kind of where this PowerPoint started a few months ago. We started talking about tariffs and taxes and all that kind of stuff. And it's gotten a little messy now because I had to update this PowerPoint so often that I probably just should have started over. But so we're going to skip through a few slides. But I think it is kind of an interesting time in tax and tariff and dealership world. My client base is all dealerships, just like you guys. They're all over the country. So you look at like the reports that Jay was showing earlier, whether it's an Iowa or whatever, those confidence reports, they kind of matter where you're at, right? And so if I'm on the East Coast, I'm worried about dairies and small tractors. If I'm on the West Coast, then trade-ins, their used inventory in California, if it gets to $2 million on a $200 million dealership, they're like, oh man, we're starting to get a little bit of used inventory here. I'm like, $2 million? Holy cow, you guys got it easy. But then here in the Midwest, that's where most of my dealerships are, and they're facing the same kind of things as you guys. So, this is on the minds of everybody. I imagine all of you got a little more inventory in your yards right now than you wish was there. And unfortunately, a lot of that inventory that's in your parking lots right now was fully created by what we're about to talk about as good news. Tax policies, tariff policies, farm policies, all those drive what makes people decide to buy equipment or not. And then depending on whether they're in the mood to buy or not the mood to buy, that's when your inventory spikes. So we're going to go through that a little bit. When Trump got elected, we all were excited, I'm sure. Whether we liked Republicans or whether we liked Trump or whether we liked Biden or whatever, everybody was a little bit excited because they were like, well, last time he was president, we got a great big tax bill. In fact, it was, if you're an accounting nerd, like at least 4 of us in the room are, and the last big tax bill that was that big was 1986. I was in high school. The rest of you guys might not have even been born yet. Were you born yet? No, dang it. All right, so I was in high school, but I claim it as mine. I bought the book to put on my shelf because I'm the oldest guy in our office in Kansas City, so it makes me look like I got some creed right there with that 1986 tax bill, because usually it's not the whole tax bill, but they put out this thing for accountants. It's like the cheat sheet for what's new in taxes this year. And most years it's about like this. In 1986 it was about like this. So that's right up there in the middle of my shelf, and I kind of like it. But in 2017 and 18, when Trump passed that last tax bill, it was the biggest one we'd seen. Lots of big changes, lots of stuff that we really liked. Unfortunately, it got so big that a lot of it had to sunset. We had to pay for it somehow. Sorry, I forgot what we're at. So a lot of it had to sunset. So that's why we're in this situation we're in now, because that stuff is starting to sunset. And whether we like it or not, there's some tax provisions headed to us, even if the government doesn't pass anything. Lately, though, we've been distracted with tariffs. And I got 5 or 6 slides here on tariffs I'm not even gonna touch because they're out of date already. When they came out, it was basically 25% on almost everything that went into making a tractor or a combine, right? So it scared the crap out of us. And back to last September 2024, I think was when Trump said, I can't wait to tariff John Deere 200%. And if that didn't scare all of you, even if you don't sell John Deere in the room, it probably should have, because like, oh my gosh, I would have thought politicians usually like getting on a big tractor and riding on it in a commercial or a trash truck or whatever. Usually it's a tractor, right? Because tractors and bulldozers and that kind of thing make for good politics. And so when he came out and said, I can't wait to tear up John Deere 200%, that should have scared the bejeebers out of all of us. It was based on some stuff that we probably would somewhat agree with. We'd like to bring all that manufacturing back, right? We'd like to see all that stuff done here and not done somewhere else. But unfortunately, when we give out during COVID 10 and 15% raises 2 times a year to our technicians and everybody else that works in our dealerships just to keep them here, you know, that gets tough to pay for. And so you can't blame the manufacturers for looking for a way to make that equipment cheaper. So that part of it we didn't mind, but now we're getting back at that, right? And saying, okay, we're gonna have some tariffs. So if you haven't been paying attention, you might even want to stop. Like he said yesterday, or this morning, the judge said it was illegal. Mark was telling me yesterday, a bill passed yesterday that probably affected why that judge did that. It was to say that judges can't make decisions like that anymore. Passed the House, the Senate hasn't done it, right? Yeah, so, but it's out there. It says judges can't do that. Today the judge does that. I will contend that as much as Trump likes to talk about fake news, this tariff stuff might be a little bit of fake news. There's some stuff in here that says it raises about $3.8 trillion. Remember that number? Because when I talk about taxes in a little bit, you'll remember the $3.8 trillion and why that's important. It also talks about, we put a lot of this stuff on hold until July 9th. That's important because we're talking about trying to pass this tax bill by July 4th. And so the fake news in that might just be, hey, if we raise tariffs and we raise $3.8 trillion, then all of a sudden we've got enough money in the economy to pay for this big tax act that we're getting ready to pass, and maybe this time it'll be permanent and not temporary like the last one. So that's my conspiracy theory for the day. I don't know, but I joke with my friends that I'd like to be in Trump's inner circle of friends, because I swear he comes over here and he's talking to his friend group and he's like, all right guys, watch this. I'm gonna go blow their minds. and then he does. He comes over, he's like, I'm gonna pass tariffs, and everybody is scared to death, right? And then the next day he comes back and does something different. And it makes politics very fun to watch. It makes volatility happen though, and it makes those of us that are kind of living and dying on what he says, what Congress says, a little hard to follow sometimes. I will contend though, again, as an accountant, that we seem to be somewhat tax neutral, because every time they pass a tax bill that makes taxes go high, we're in demand. And then when they cut taxes, we're in demand to do tax planning. So they kind of do us a favor, right? Because they always make the accountants in demand. But what it also does is it makes me know that never get too scared about any of these policies, because they're going to change again. And that's what we're going to see with this. So we're going to skip most of the tariff talk. You know, you saw this, and it scared us for a minute. And what didn't scare us, we liked, right? It's kind of like, well, if they're going to tariff us, we got to tariff them. This chart made all kinds of sense in the world. It looked like when you saw the tariffs that other countries are charging us, our number always looked like at the most it was half of what they were charging us, and right now it's even less than that, so why wouldn't we get some of that back? It's just you can't pass tariff policy like this and then hope that you pass a tax bill to offset it later. If you can't pass both of them at the same time, it really puts us in a precarious situation. So that's why I think it'll all work itself out. The reason the judge had to step in yesterday is most of the stuff that these tariffs are passed on were based on laws that tariffs were never meant to be passed on. They were securities, war acts, and things like that. And in case you're not a Trump fan in the room and you're like, yeah, he should never pass tariffs based on those laws, also realize that the state tax that maybe your parents or grandparents have had to pay in the past, that was to pay for World War I. Actually, it wasn't even World War I. It was the Spanish, whichever one came. What war was right before World War I? Randy, you're old enough to know that. Just kidding. No, it was a Spanish American or something like that. It was the war right before World War I. That's what estate taxes were actually put in place to pay for, and we still have estate taxes to this day. So those of you that get angry that Trump might have passed tariffs based on laws that weren't appropriate, politicians do it all the time. Certainly, again, some of the justification for tariffs is out there. We need to be a player in the world. We need to not pay other people more than we're getting paid and that kind of stuff. So all that stuff makes sense, but it does lead to uncertainty which makes it tough for us to do business. It makes our farmers really nervous. Just so you know, what it does to the overall economy rate though, currently tariffs cost U.S. companies about $76 billion. Okay, sounds like a lot. Under this new scenario, if you believe the math that people run, it's about $969 billion. So it is a 13x increase from 76 to 969. When you look at the $969 billion of tariffs that it raises, about half of that is for stuff that was in the 76 billion, stuff that had always been tariffed before. So it takes the 76 billion up to 460 some billion dollars. So about half of that 969 billion is stuff that was tariffed before. But the other half is stuff that wasn't tariffed before. So that's even more scary, right? So $969 billion, half of it's new. And then the reason we talk about tariffs mainly being a Canada and a China and a Mexico thing is of that $969 billion, about $650 billion of that is on China, goods coming from China. And yeah, that affects some of our tractor parts and some of the steel and stuff like that. But really what it affects is Temu and Amazon and Walmart and stuff like that. So that, again, that might not affect us as dealers, but it does affect our customers and the amount of cash flow they have left, because that ultimately gets down there. So 650 billion comes from China, about 60 billion in each. I think it's 65 to Mexico and 62, or I might have that backwards. One of them 65, one of them 62. About $60 billion a piece is Canada and Mexico. So it used to be 76 billion total. Now each of those countries are about $60 billion. So you can see it is a meaningful impact. But when we're talking about trillions of dollars on everything else, these billions of dollars seem like nothing, right? Like surely we can get through this $1 billion thing. I think it was there was a politician in Chicago that long ago, it was back in the 50s, and said, you know, billion here, billion there. Pretty soon we're talking about real money. That's how our politicians think. So $76 billion to $969 billion, that's what you got to remember on tariffs. It does hurt us a little bit. Again, most of it's China. We're talking about retaliatory tariffs. All that stuff's on hold right now. A couple weeks ago, China and the U.S., China blinked. U.S. probably lucked out a little bit. So maybe we won't be seeing 125 and 145% tariffs. Maybe it'll be something less. I'd say stay tuned for that. July 9th is the big deal. What's really important though is usually we might pass 1 or 2 economic policies with another country, tariff policies, a year. We have 200 of these things to pass now before July 9th. And that seems pretty much impossible to me, but maybe we will. So we need to pass 3 of them anyway. We need to figure those 3 out. But 200 seems like a pretty daunting task. So what that leads us to is certainly we're going to have uncertainty. And uncertainty is what makes your farmers sit there and say, oh, I better hold on to my cash. I don't know what taxes are going to do. I don't know what tariffs are going to do. I don't know what corn prices are going to do. I'm just scared right now. And I got a little bit of cash that I got in April, which is actually, it doesn't sound like much, but it doubled the amount of government assistance dollars that would have come to farmers otherwise this year. That's how bad farm policy has gotten, is that a little amount of money that they put out in the economy, I think it was 30 billion or something like that, they put in December, that more than doubled what the farmers have gotten lately, and that's why we need to see that change. So there's a lot of uncertainty, and uncertainty usually leads to bad things for us. So people ask me a lot, okay, so as an equipment dealer, what do I do with this tariff thing? And you know, I think the first thing is to stay calm a little bit. First off, none of it is official yet, right? Until July 9th, none of it's official. I know that some of you might have already gotten phone calls, because I've heard this from my dealers, that hey, your shipment that's on the boat on the way here, we're going to have to charge you 25% more than we already put that in, and you can't cancel it. That's always scary news to hear. Especially when it's not even official yet that tariff is going to be in place. So I'm not sure how that's happening, but that's what the manufacturers economists are also panicking. They're like, oh crap, what do we do? There was a survey that put out of CFOs of major manufacturers, not just your manufacturers, but manufacturers in general. What are you going to do with tariffs? Are you going to pass them through? Or you're not going to pass them through? And I don't know that I believe surveys, but because on that survey, only 41% of it came back as a CFO saying, yes, we're going to fully pass the tariff through. Whatever we get charged, we're going to pass it through to the customer or to our distribution network, and then they'll pass it on to their customer. I can't hardly believe that only 41% would pass those tariffs through, because if it's 25+%, you know, that's more than some of their profit margins are already. So I don't quite believe that survey, but it's out there. I think for equipment dealers, you know, the biggest things I would say is first and foremost, it is an OEM response. You know, what are they going to do with it? They've got to be somewhat careful. You guys have canceled so many orders or pared your orders down in the last couple of years that, you know, they've shut some factories down. They've not. If they didn't shut them down, they might have cut a shift or two or moved some of it down to Mexico. So they make their money producing equipment, right? So when you guys say, hey, I only need 25 combines next year, not 100, you know, when they did do that across their distribution network, that gets pretty scary to them. So this is certainly scary. They got to figure that out, and their response to you is probably somewhat on that. But they're the ones that got to worry about this the most. They can't afford to have 20 and 25% price increases every year, you know, like we've had for the last few years. So they were probably breathing a sigh of relief. Hey, we don't have to raise prices as much this year, and then the tariff thing comes on. So then it gets to you guys, and then what do we do with trade-in prices? You're dealing a little bit with this now, that you know, equipment got super expensive during COVID when you ran out of equipment. And because you ran out of equipment then, the equipment was more valuable then when they bought it, and they remember writing the check 2 years ago, and now they're trying to trade it in. You're like, it's not worth that anymore. So you're dealing with that a little bit now. And now we've got this other situation where if we start raising the price of equipment solely because of a tariff, that's not valuable 2 years from now, right? That tariff might not even be here 2 years from now. And so now we're like, what do we do? So I've heard some saying, well, maybe we'll have a line item for the tariff. That's probably actually a smart idea. I'm not sure. That somebody higher than me will figure that out. But if you have a line item for the tariff, at least then the farmer can remember, okay, I paid $100,000 for the piece of equipment, then I paid $20,000 for the tariff. My total was $120,000. So that when they bring that back to you 2 years from now and they say, I paid $100,000 for this, why aren't you giving me at least 80? And you're saying, well, 20 of that was a tariff, and that tariff is now less than that. That tariff doesn't have anything to do with the value of the equipment. So that's going to be a big rub for you guys. And whether you're right or they're right because they're the customer, right? And they'll be a little bit pissy when they trade in their equipment and you're not giving them what they deem as full value for it. So that's going to be your biggest thing. You're going to have to kind of figure that part out. And then just the customer sentiment. You know, in general, I think Jay showed you a couple different ones. Another one we look at is the Creighton report, and that one is really for the customers right in here, Iowa, Nebraska, and Minnesota, our big row crop farmers right here in the Midwest. And that one right now, you know, there's a line at 50, and when that number is above 50, the farmer says, hey, next year's going to be better. I'm going to make a little bit more money. I'm feeling optimistic about next year. I think the economy is growing, kind of thing. When it's under 50, it's the opposite of that. And generally, when I look at that, I think there's 15 states that report into that. And generally, everybody's hovering right around that 50. About 75% of them are above the 50, and there might be one or two that dip below the 50 once or twice during the year. In a post-election year, though, we would almost always see that number up in the 60s and 70s for every state in that. And right now, even just May of now, I guess the last one they reported on was April, there's only 2 states that are above 50, and that's Missouri and Colorado. And if you pay attention to that report, Missouri and Colorado's numbers never mean anything, partially because Missouri is 2 states and it conflicts. You know, we got crops on the one half, and we got cattle on the other half, and so those conflict. And in Colorado, it's all about hemp and small ag and oil more than crop production. So those 2 numbers are always off, and they're the only ones that are above 50 right now. And even they do a similar one for crops, and those are all under, or not crops, land values, and those are all under 50 right now, meaning people are saying, well, I think the land we might be coming to the end on that, which none of us believe that, because like his Iowa index, how often does the Iowa land come up for sale and goes below what we think it's going to go? So I think some of that's subjective, and a lot of it is just noise, and we just got to live through it. Okay, so anybody remember these guys on the right? Paul Ryan and Kevin McCarthy. Doesn't that seem like eons ago that those guys were in politics? They're the ones that passed the big bill back in 2018. Now we got a new set of people. Johnson from Louisiana as Speaker of the House, and we got a big beautiful bill. Anybody heard of the big beautiful bill? Like I said, last week it passed 2 hours before I got on stage, so I was changing my PowerPoint. So I felt pretty good this week. I didn't have to change much of it at the last minute. We're going to come back to the big beautiful bill because it did pass the House. That doesn't mean it's passed. They literally set this thing up for reconciliation. When you read the introduction paragraphs to it, it says this is a bill for reconciliation. Usually they decide later whether it's going to be for reconciliation or not, because that means they don't have enough votes to get a 2/3 majority. They know they're going to pass at 51%. This one they designed for a 51% vote. But what I want to talk about first is the 2018 Act. Even if Congress doesn't do anything, this stuff does expire this year. So this is important for us to realize what's going to happen even if we don't get some legislation. And I got to change my positioning here so I can go through this. So pardon me on this side of the room. I'm going to look this way for a second. Okay, the biggest ones for you guys is the 199A deduction. Or you guys might know it as the 20% haircut. It's basically if your dealership is operating, or your customer's farming operation is operating as a partnership or an S corporation or an individual, they have a different tax rate than the C corporation rate. The only thing that was made permanent back in 2018 was the C corporation rate. It was made permanent at 21%. And for those of you who don't know what permanent means it's that way until they change it again. Literally. So it was 20. They wanted it to be 20%, but that number was a few $1 billion off, so they made it 21% to make it permanent, because they wanted that one to be at least permanent, so our corporations could at least know what their tax rate was going to be. Well, now the corporations know what their tax rate is going to be, and we know that if they're at 21%, and our biggest rate for individuals is 39.6%, or was going to be 39.6% again next year, then if I'm an S corporation or a partnership or a sole proprietor, then my taxes come through and I got to pay the profits of my business at 39.6%, not 21%. That's not fair. So they put in this 199A deduction, which was basically the first 20% of the profits of that entity. You don't pay the tax on that. So basically it gets the effective rate down to 29.77%. Interestingly, that's for everybody except accounting firms and law firms. I don't know why they singled us out. They said everybody else can get their 20% off, but you guys, you're going to benefit from this bill, I think is what they were thinking. And so they said we don't. So like I get a K1 from opinion, and I got to pay the full rate on mine. You guys get 20% deduction, so at least celebrate that, right? The other one is bonus depreciation. Bonus depreciation. If you weren't paying attention, back in 2018, we got that up to 100%. And that wasn't just a freebie from the government. They had to put that in place because they got rid of like-kind exchange on equipment. Remember that one? It used to be farmer traded in like combine for a combine. They didn't pay tax on the combine they traded in. They just got to depreciate the difference in the future. Starting in 2018, that went away, and so if they traded in a combine and made a $20,000 profit on it, they had to pay the tax on the 20%, the $20,000 profit, and then they got to deduct the new one. They didn't care. They didn't notice they were paying the tax on the profit here because they got to write off the 100% of the new one. So it felt like a freebie. It wasn't a freebie. It was to replace an old freebie, right? So bonus depreciation, though, it was 100% for the first few years, and in the last few years it's been going down 20% a year, such that in 2025, it's 40%. So a farmer buys a $100,000 piece of equipment, they only get to write off 40,000 of it, and the other 60,000 they write off over the next 5 years. So they don't lose the deduction, but they didn't get to write it all off, which makes them think, I didn't get as big a deduction, it's not worth as much to me, maybe I shouldn't buy it this year. That number is 20% next year, and then 0 if they don't pass something different. So that's a big deal. That one, they've been, I don't know if you've been paying attention, but for the last, since 2018, it was about every 3 months they were having to pass a continuing resolution to keep the government afloat. Remember that? Because we were out of money. And every time, everybody raised their hand and said, oh, we should throw bonus depreciation fix on there because that'll help the economy, and they never did. Partially because they wanted to be relevant, right? They like being in the news. They like us saying, hey, we wish you'd do this for us, and they say, well, we want you to do this for us, kind of thing. So that hasn't passed, but now it's coming to a head. They're going to have to. The other things that are in there, research and development credit. This isn't a big deal for you guys as dealerships, but it can be a big deal for your customers. It's a great credit, and it was one that when a farming entity or whoever is doing something out there to make their business better, and they're spending a lot of money on research and developing a new product or a new way of doing business, they can take a credit for that. It used to be they could deduct that expense. So the credit sounded great until they get to the year that they spend all the money, and they said, I spent $1 million, I want to get my credit. And they say, and then now the rule is, well, but you can't deduct your $1 million. You got to capitalize your $1 million. So the credit doesn't seem that great because they got to capitalize the $1 million that they would have expensed anyway. That was something that was new, and hopefully that gets fixed. And then the business interest deduction. Any of your dealerships paying a lot more interest than you've paid in the past? Yeah, so, and the reason that was because last year they switched it from at least, it used to be, there was 1 year that they made the number a little bit better, but it's basically 30%. It was 30%, it can't exceed 30% of your EBITDA. Last year, though, they took away depreciation and amortization, so it's 30% of your earnings without adding back depreciation, which is usually a big number. Also a big number for your customers. And when interest deductions start getting limited, people tend to not want to buy things on credit. And I don't know if you've noticed or not, but $1 million combine or even a $600,000 combine is a little bit hard to pay for in cash. And so that interest deduction, getting that back to full deductibility is pretty big for our customers. Individual tax rates also are set to go to 39.6%. Their highest rate was 37%. That expires, goes back to 39.6 next year. Standard deductions, most people for the last few years have taken a standard deduction. Even though they bring their shoebox into the accountant and say, hey, here's my stuff, do my tax return and deduct all this stuff, the accountant goes through all that stuff and says, oh, well, you didn't have that big of a mortgage interest, and by the way, we have a tax limitation I'll talk about in a second. We took the standard deduction on you. And that was okay too because they raised the standard deduction really high. In fact, it was so high that nobody noticed that we also got rid of personal exemptions. So it used to be when you filled out your tax return, you had 12 kids, you said, oh my gosh, I get $24,000 worth of free tax pay, $2,000 a kid. That went away. Nobody noticed because we raised the standard deduction so high. Ryan, did you do that? At least that was my water, not somebody else's. Somebody will get that later, hopefully. So that goes back down though to normal levels next year. So if you're not, if you don't have that big tax deduction on your tax number that we're going to get to here in a second, that's going to increase your taxes quite a bit as well. Then we've got the charitable deductions. Not a whole lot of change there. It just goes from 60% back down to 50%. The SALT deduction, that's a big one. So that's state and local tax deduction. If you haven't noticed on that one, what that basically means is nobody can deduct more than $10,000 on their tax return for state and local taxes. And state and local taxes are your income taxes, your personal property taxes, your real estate taxes, all of that together. $10,000 doesn't go very far when you add all that stuff in there. Most people are capped at $10,000. That really impacted states on the coast more than it did us, other than Minnesota. Minnesota thinks it's on the coast. I guess it is if you count the lakes up there. But those states that have really big tax rates, their people never notice that they have big tax rates because if I had a 15% tax rate in my state versus a 5% tax rate like most of our states have, it didn't matter because I got to deduct all the taxes I paid in my state off of my federal return, and I wound up in the same place. All it meant was people in the 5% states were subsidizing the taxes in the 15% states. So those 15% states got a little grumpy about it. So we passed something called pass-through entity elections. Anybody a CFO in the room that had to deal with that in your entities? So pass-through entity deduction just meant, okay, if we have a bunch of shareholders that pay the tax on my business anyway, we're going to pay the tax in the business instead of having the shareholders pay it. So we set up these elaborate mechanisms to do this pass-through entity tax to help us offset the salt limitation. So that's going to come back into play also. And then the child tax credit, it's $2,000 a kid. That's going to go away if we don't pass something. So again, most of that impacts your customers more than you, but your customers not having cash because they paid it all in tax ultimately affects you really bad. And then this one, especially for an equipment dealer dealing with farm equipment, this is a big deal. Not just for the owners of your company, but more importantly for the owners of your farming customers that have lots of land. Back when I started as an accountant, the limit for your estate was $625,000. So if you had $626,000, you had an estate tax. That number has morphed through the year. If you were lucky and died in 2010, like George Steinbrenner, there was 1 year in there where George Bush was able to have it so that we had 0%. The estate tax went away for 1 year, 2010. And a whole bunch of people died. It was weird. All these people that were, just kidding. But George Steinbrenner did die, and he died with a really big estate. And so people like to talk about George Steinbrenner, not just because they hate the Yankees, but because his estate was free. After 2010, it went back up again, and it was around the $1 million mark for a while. Then in 2018, we went to, effectively, it's got now to $13.5 million per person. So you don't pay estate tax unless your estate was over $13.5 million. So for a married couple, that's $27 million. So that goes a long way towards helping things. In 26, that number goes back down to $5 million. You'll notice I have $7 million-ish up here because it's $5 million adjusted for inflation. So in case you weren't paying attention to how bad inflation is, that's how bad inflation is. $5 million in 2018 is $7 million in 2026. And so anything over $7 million would be taxed at about 40%. That's a pretty big deal when farm ground isn't cash. So what it means is we could see some farm ground turn hands just to pay the tax bill if this doesn't get fixed. So that gets us to today. And when I first did this thing, I thought, oh, I should have made these bracelets. What would Trump want? Remember like the WWTW bracelets? What would Jesus do? It's like, what would Trump want? And then I Googled it because I was trying to find a picture of a bracelet, and I was going to superimpose Trump on there. And I Googled it, and somebody was already selling these bracelets. So my great idea didn't do any good. But what would Trump want? Well, Trump wants at least all of the good stuff from 2018 made permanent. To make it permanent is going to be a pretty good jump, and we're going to talk about that in just half a second. But in addition to that, he wants some other stuff as well. He'd like to see lower the corporate tax rate from 21 to 15%, at least for the companies he likes, meaning the companies that are American. We'd like to see the companies that primarily do business in America to get their corporate tax rate down to 15%. He would also like to see exempt tip income. You've heard that one. Exempt Social Security income. You've heard that one. I kind of like that one. I hate in tax world. There's a technical term. Do you know it? The little old lady tax returns. You know it. The little old lady tax returns. All of us get stuck with these little old lady tax returns in a CPA firm that we got to charge them to do their tax return. And the only thing they've got is Social Security, and they got to pay tax on it. And it's like really annoying to have to go to the little old lady and say, "Oh, you owe tax," and then she cries and all that kind of stuff. And then you pawn it off onto somebody else. And it's like, I don't want to do these little old lady tax returns. They just break my heart. So I kind of like the Social Security thing not being taxable. There's another one in there though that says exempting overtime income. That one I don't understand at all. It sounds good. It'd save you guys a little bit of money because you wouldn't have to pay Social Security taxes on your technicians' overtime, but that's only going to save you a little bit of money. I don't understand why earned income would be not taxable, but maybe. And then another one, a lot of people buy a car and think, well, it's a good tax write-off. Nobody pays attention. Their accountant doesn't write their car off. If you're an employee, it's not a deduction. And they think, well, at least I'll get the interest. I'll get to deduct the interest. No, you don't. Your accountant might have told you did, but it's not deductible. It's never been deductible, actually, unless you own a business. Everybody thought it was. Trump was going to make it deductible if he gets his way on that one. And it was mainly only for American-made cars. So again, the one good thing about that, and you'll see it here in a second, is that might also include American-made other stuff that look like cars, like ATVs and stuff like that. So that can help you a little bit. And then, in addition to all that, we also want to cut government employment and waste. That'll help pay for it. We got to deal with this pesky debt limit. We're $36 trillion in debt, in case you didn't pay attention. We got to pass a farm bill because we haven't had one really in place since 2018. We had a bunch of extensions since then. If you're on the construction side of equipment dealers, you hear about the highway funds and transportation. We haven't had a real one of those in a long time either. We've just had extensions. And that's why at some point the construction equipment industry is also going to be in trouble, but they haven't been yet. You can't read all these, but don't worry about them. Notice that most of them are red. So this is how much all that stuff would cost. And you'll remember though that I said one number, 3.8 trillion. I guess it's not on this one, it's in a second. But all that stuff costs. All this is all the extra stuff he wants up here. It's somewhere between an extra $7 trillion and $16 trillion. This is how he's going to pay for it. We got tariffs and we got DOG, and that's going to save somewhere between $2.5 and $5.5 trillion. And that'll affect the interest that we pay, and then so that the total deficit impact can be somewhere basically between 0 and $15 trillion, which those are big numbers. We can't get the bill to be permanent unless it's only that somewhere in that $1.6 trillion level. So most likely we're going to see a bill that is going to also expire just like this last one did. So that brings us to today. The big beautiful bill did pass. Passing last week doesn't mean anything, it just means it passed the House. Remember, it was set up for reconciliation, which means the bill that the House passes and the bill that the Senate eventually passes and then sends back to the House, they gotta all agree. Those two bills have to be pretty much exactly the same bill. They can't disagree or they can't reconcile. You ever reconciled your bank statement, it has to come to 0, right? Can't come. I learned early on in my career, before I worked on equipment dealers, I worked on banks. And there was a bank in Topeka, and I made a journal entry because I was an accountant, and I did it all right. I got to the end, and I got a call from the president of the bank the next day. He said, Mark, this is, well, he's dead now, so I can say his name. This is Anderson Chandler, president of Fidelity State Bank. I was like, yeah. He's like, did you really send me a journal entry for $8? I was like, yeah, that's what accountants do. No, we balance things, we reconcile. He's like, no. So then I got introduced to materiality. So never do an $8 journal entry to a bank, they get angry. But reconciling means it has to come to 0. So those two bills have to look exactly the same or they can't pass on that one, that 51-50 type vote. And that'll get rid of the sunsets if we can make it permanent, but I don't know if we'll get to the permanent part. Okay, so I'm sorry, skip the most important one. First one. The estate tax limit is restored to $15 million, and they want it to be permanent. In fact, they've separated that from the rest of the tax bill to say we specifically want that one to be permanent because this one really creates uncertainty. We can't deal with, is an estate going to be $1 million, is it going to be $5 million, is it going to be $15 million before it gets taxable? We can't make long-term decisions if we don't know what our long-term estate tax bills are going to look like. So that one they're saying would be permanent. That starts on 1/1/26. So, and that's okay because the current bill is good through 12/31/25. So that's good. Next one, business tax provisions. The pass-through deduction does get, it also gets made permanent. That's only fair that it's permanent if the C Corp rate's permanent, right? And it goes from 20% to 23%. So now with the effective tax rate only being at 37% at its highest, and we get the first 23% off, that means that we wind up with an effective rate of 28.49%. Still not as good as 21%, but better than 37%, right? So in general, us and our customers will have less tax on our profits. Bonus depreciation, it gets restored, and it would be 100%. This one's funny, 100%. And it's retroactive, but not to when Joe Biden was president through January 19th. If you bought it between January 1st and January 19th of 2025, it's only 40% deductible. If you bought it after Trump was inaugurated on January 20th, then it's 100%. That's actually kind of funny and a little bit of a spike the football kind of thing that I kind of like, right? Those kind of funnies in politics are sometimes kind of good. And that's not permanent though. That only goes through January 1st, 2030, which guess who's not president then? So that's a good deal. And also though, it does make bonus depreciation a little bit better than it was with a higher limit to phase out. So most of your farmers can usually do bonus depreciation unless they're a big multi-unit purchaser that's buying, $5 million fleets at a time. When they do that, they can't use Section 179, they gotta use bonus. But if you're a normal farmer that's coming in and buying onesie, twosie pieces of equipment and buys less than that amount, they can still write it off, so that's good. The research and development, we're able to fully expense that. The business interest deduction, it doesn't go away, but it goes back to EBITDA. So that kind of goes back to a couple years ago and it should at least make us so we're gonna get full deductibility of our interest in most cases. And depending on if you believe economists or not, I've been to several presentations in the last few months. Now these were bank economists, so they have I don't know if that means they have inside knowledge or if they have something to gain from saying this, but they all are still saying we think we'll still see an interest rate decrease of up to 1% in 2025. Whether that comes in one or two different cuts, they still think that's going to come. So that could be helpful as well. Trump thinks he can call up the Fed and say, hey, reduce the interest rate. I wish he could, but he can't. In fact, I think if he did, they'd do the opposite. On the individual side, the 39.6 rate will not return. Will be where we're at. The standard deduction will stay high where it's at, about $26,000. Mortgage interest, that's a bad one. That one actually goes back to, you can only deduct the interest up to a house that costs $750,000, which I don't know about in this part of the world, but in Kansas City, $750,000 is not that great of a house. And I mean, it's still a great house, right? But that used to be about a $200,000 house. Now it's a $750,000 house. It seems like I got a flyer the other day of all the $1 million houses for sale in Kansas City, and it just surprised me how many. It used to be that was a handful of houses, and now it's most of that document is $1 million house. Well, you can only deduct interest on the first $750,000. That returns. Charitable deductions goes back to 50%, not 60%. So those are two pay-fors, but that's okay. That's what it's always been. The SALT deduction, this is a good and bad. This is where probably the Congress and the Senate disagree the most. What that number ought to be. It sounded like it was going to go to $40,000. Some people wanted to go completely away. What the House wound up with is $30,000. They said, okay, instead of 10, we'll do 30. But to pay for it, all this stuff you guys have done with pass-through entity elections that I talked about, and if you set up that for lack of a better word, I'm gonna call it a scheme for a second. It's not a scheme because it's legitimate, but if you set up that scheme in your dealership to do that, it's no good anymore. It can't do it. So that means nobody gets to deduct more than $30,000 on their individual tax return going forward. So that one will hurt a little bit, but at least it's better than 10. Again, standard deductions are good, and child tax credits stay good too, and actually go up just a little bit. Some other possible provisions on there. I won't make you raise your hands, but any of you had ERC or ERTC claims? Those are a little bit controversial. It's basically PPP on steroids that came out afterwards, and some dealerships didn't do it, some dealerships did. I mean, I had some of the dealerships that we work with, we got $10 million of ERC money, but when we got it, it was like, careful, there's a whole bunch of these bad apples going around filing these ERTC claims, and the government might come back after you and ask for their $10 million back, or they might threaten that they're going to send you to jail kind of thing. And there were some bad apples out there, just like there were some bad apples in the PPP loan. What this does is says, okay, we're gonna, because those got put on hold about a year and a half ago, and they just started recently putting them back, filing those claims again. But they're saying if you filed it after 1/31/24, it's done. You're not going to get it. If you filed it before 1/31/24, we're still going to process those claims, and we're going to set what the new time that we can go after you and claim those back is. So at least that gives us some clarity on that. It eliminates de minimis tariffs. So we had these we had really low tariffs on some countries, and when it came through and it was less than $700 or $800, they basically said, well, you don't have to collect it. That's so low, we don't have to collect it, which is kind of dumb. If there's a tariff, you might as well collect it, so it gets rid of that. Manufacturers accounting, this is more, again, for your manufacturers, and it wouldn't be for like the big ones, your mainline manufacturers. Would be more for like your short line manufacturers. They might be able to use a simpler style of accounting with cash method of accounting, which means they can deduct their expenses easier, which means they might make more money, which means they might not have to pass through as much to you. And then we got the IRA tax credits. An IRA doesn't mean money you put into your retirement account. This was that stupid bill that they named IRA that stood for Inflation Reduction Act, which all it did was make inflation Continue Act is what they should have called it, but instead they called it the Inflation Reduction Act, and it had a bunch of this green policy credits and green energy stuff that whether or not you believe in that or not, that's not a political statement. There was just a lot of expense. There was billions and billions of dollars of tax credits and incentives out there for EV vehicles and all that kind of stuff. In fact, I bought EV stock when Joe Biden became president because I was like, I'm finally going to make money on one of these things, and it crashed too. I just don't play the stock market game right, evidently. But a lot of those go away, and then opportunity zone credits, those actually come back. So in Nebraska and Iowa particularly, there's a lot of opportunity zones people can invest in and not pay capital gains tax on in those. So those are good. In fact, you might be able to build dealerships and buildings like that in areas like that and save on some property taxes and things. And Trump got his way on a lot of this stuff. No tax on tips, no tax on overtime. There's actually a $4,000 deduction just for being old, but you gotta be older than me. You gotta be 65. I'm only 56, so maybe in a few years I'll get some more of that. We get $4,000 deduction for senior citizens. No tax on interest for the purchase of so what no tax means, you actually get a tax deduction for it. But it's not just autos, it would be actually ATVs and a lot of things you sell in that in your dealerships there, so that would be good. If they're final assembled in the U.S., which most stuff, I don't know if final assembled, maybe if it's not final assembled, you guys should always just put a ratchet on it maybe when it comes in and say, I had to final tighten that thing. And then my favorite in this thing, the last Spike the Football thing, is something called a MAGA account. And it's not, Make America Great Again. It doesn't technically stand for Make America Great Again. It's money accounts for growth and advancement. And this is the dumbest thing I ever saw because it really is, it doesn't mean anything. You can put money in an account for your kids, and someday they can take it out for education or entrepreneurship or buying a first home. There's a whole bunch of stuff they can take it out for, and it advances or it makes education better, that kind of thing. And they'll only pay capital gains on it if they take it out, which they would have anyway, right? If you would have invested in a stock and then they took it out, they'd pay capital gains. So it's just I don't understand it. It's kind of a Spike the Football thing again. But again, some of that stuff is kind of funny when you've been losing a bunch of years and now we're winning, tired of winning kind of thing, right? If you remember that statement. So the MAGA account. And then, unfortunately, it increases the debt by $4 trillion. $4 trillion is a little too much. The Congress has said, the House said we won't accept a bill for permanency that's over 1.6 something billion or trillion, and the Senate has done a $4 trillion number. So $4 trillion could make it on the Senate side, but could make it on the House side. There are some, as Jay said earlier, there are some farm bill type provisions in that, and these are good for us in general. It increases the cap from $125,000 to $155,000, so people can make a little bit more money and still get their full farm bill payment. It expands the idea of what agriculture exemption is, and it's not just money you make on the farm, but it's stuff related to a farm. It can be agritourism, it can be ag education and things like that. So that's helpful a little bit too, because it makes it so that can be more included, and then increase the reference prices. So in general, we've got some good stuff on the farm bill stuff here, but there's also some bad farm bill stuff. For those of you that like One Beautiful Bill is like the media making fun of Trump and saying, oh yeah, we're gonna really get him on this, we're gonna call it the One Big Beautiful Bill. It actually wasn't the media. This is actually the name of the bill. I copied this from the House Ways and Committee. It actually is called the One Big Beautiful Bill, and more than that, you can see all the Spike the Football. The subtitle A is Make American Families and Workers Thrive Again. These sound like political statements again. Section B, and that is where we give us some of the credits back. Make rural America and Main Street grow again. That's one of the ones that we have to pay attention to again, that section, because that's some of the stuff that the Senate is really gonna grapple with, and that is there's some stuff about Medicaid reform in there. Basically, you gotta have a job or you're looking for a job to qualify for some stuff. It redefines some rural hospital stuff, and that's one that I know particularly Iowa's got an issue with that, with Grassley, and so we got to pay attention to that and see where that shakes out. Then we got Make America Win Again, and that is basically everything in there is going through everything from the Inflation Reduction Act and saying, no, 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 we're not giving any of these credits. And at first that sounds really fun and I kind of like the idea. On the other hand, it does take away all of this. It's very contentious, meaning there's no Democrat that's ever going to vote for it because it gets rid of all the climate stuff, and it's very not climate neutral. So voting for it or against it is quite a political statement on that side. And then the last part is increase the debt limit. I would suggest if any of you, I think, Jamie, are you sending these out to people? If not, you can, my phone number's up on the end. I can give you a copy of this. This site is actually, it's only a 47-page document, and it goes through what this is. It's a lot better than the real document, but this is only 47 pages. It's actually kind of a funny read if you want to read it. Reconciliation, so the next step is House passed it. The next one is the Senate has to pass some version of it. It will most likely be different. In fact, I think I put the quote in there, no, it's somewhere else. The Senate has said, yeah, basically we're going to have to make a bunch of changes, which means it's going to have to go back to the House. They're going to have to agree for it. People have said it's going to be passed in June. It ain't going to be passed in June. Then they say, well, it's going to be passed by July 4th. There's no way. It's probably going to be passed sometime before the Labor Day research or the Labor Day recess. We'll see, but I just don't see it. There's a lot of stuff that they disagree on. But it is a pretty funny read if you want to look at it. The things that they're really struggling with are the Medicaid reform and specifically how it affects rural hospitals. And I don't mean to make light of that. And particularly, I live in Kansas. You guys live in Iowa. I mean, there's some stuff in there that really could impact rural hospitals kind of in a bad way. The Farm Bill, we got to see something passed there. And you know, the Farm Bill, as we all know, is as much about SNAP funding as it is about Farm Bill. And there's some SNAP cuts in here, and that's going to be hard for some people to pass. Biofuels, you know, we got states like Iowa that say, hey, if you touch the 45Z credit, you know, we're not going to vote for it. We got to have that in there. We got to, and I agree, we got to have corn prices good. And so there's some biofuel stuff in there. And then all the while, the USDA is reorganizing, trying to cut 30,000 jobs, which is 30% of their workforce. They're the ones that are going to have to implement this kind of stuff, and that's going to be kind of messy. Here's my quote. I expect there will be considerable changes in the Senate. That's what almost every senator says when they're interviewed on CNN or Fox News or whichever one. And as writer for reconciliation, work bills have to be aligned. And because I'm an accountant, and I also kind of like Sudoku once in a while, I threw in some random numbers here for you. If you can guess what these numbers are, you win a prize. This is just a reminder. The House, the margins are very slim. 220 Republicans, 212 Democrats, and 3 that are vacant right now, which I think about half of those will come back, which half is 1.5, which most senators or most House members are worth half, but no, I don't know. That won't affect the 220 and 12 much, but it might make it 220, 215 or some version in there. You might say, well, that bill passed last week with 229, 215 to 214. There's 429. I mean. There's 435 senators, or 435 House members. Where the rest of them go? One of them actually admitted, I was asleep during the bill and I missed it. The other 2 were abstentions, which I think is pretty funny that one of them actually admitted that they were asleep. They did pass it at 5 o'clock in the morning. The Senate, they're a little bit better at 53-47, but again, not much room for error there. 3.8 trillion is the number that it looks like it's going to be, which 3.8 trillion, remember, that could be what we raise in tariff money, which is the same pots that could make it permanent. Or if you believe some people, it says, well, if we score this thing right, some of these tax things hadn't happened yet, and some of this spending hadn't happened yet. If we score it right and do it differently than we've done it in the past, then there's actually, this impacts the deficit 0. It's hard to understand that math, but there is a chance out there that this could be permanent, is all I'm saying there. Again, the House says about 1.5 trillion, the Senate says 4.5 trillion is 0. That number, though, will add to a $36.2 trillion debt that we have already. And for those of you that don't know what a trillion is, if any of your dealerships made a few million in the prior years, or lost $1 million this first quarter, which a lot of my dealerships did, lost a bunch of money the first quarter. $1 million has 6 zeros in it. $1 billion has 9 zeros in it, and $1 trillion has 12 zeros in it. So if you think about how hard it was to make $1 million with your 6 zeros in it, $1 trillion has 12 zeros in it. And that's how big 36.2 trillion plus whatever we add to it is. So all in all, it's kind of a messed up system. We'll like it for now, we won't like it later, and then we'll like another bill later. So I'm saying stay calm, do business as usual, do the right thing for your customer, and this will eventually kind of work itself out. There's my contact information if you want this slide. I don't write a weekly newsletter because sure enough, if I did that the second week into writing a weekly newsletter, I would forget to do it. But one of the guys on our team does. This guy used to actually work for Congress, so he actually has a pretty good read. If you want to follow any of our stuff, you can follow Brian Keel on here. And like I said, if anybody would want this presentation, I can send it to you. Just send me an email and I'll send it back to you. So that's all I got.